There is a question buried inside one of the most accepted facts in American financial history. It is not a complicated question. It does not require specialized knowledge to understand. But once it is noticed, it becomes difficult to ignore. Most people, when asked why the United States introduced a federal income tax, will offer some version of the same answer. The government needed more money. The old system of collecting revenue was unreliable. The country was growing. Expenses were rising, and something had to change. It sounds logical. It sounds inevitable. And for most of the 20th century, that explanation has been repeated so many times in textbooks, classrooms, and official summaries that it has started to feel like settled history. But here is where it becomes unclear. Before the income tax existed, before it was even seriously proposed as a permanent solution, the United States federal government ran a budget surplus for 28 consecutive years. That is not a rounding error or a brief period of good fortune. 28 years in a row, from 1866 to 1893, the federal government collected more money than it spent, every single year, without interruption, and during that entire period, there was no income tax. None at all. The government was funding itself, managing its obligations, and still had money left over, year after year, without taxing the income of its citizens. That detail alone raises a question the standard explanation does not fully answer. When historians describe the path toward the 16th Amendment, which was ratified in 1913 and formally established the federal income tax, the usual narrative focuses on inequality, the power of industrial wealth, and the desire to shift the burden of funding the government away from consumption taxes and toward the incomes of the very wealthy. Those are real arguments that were genuinely made at the time. But what is quietly absent from most of those explanations is any serious engagement with what the numbers actually showed during the previous 3 decades. The surplus was not small. In some of those years, the federal government was collecting somewhere close to 40% more than it was actually spending. That is a substantial margin. And yet the dominant story skips over this period almost entirely, as if it is an inconvenient interruption in an otherwise clean narrative. This is where the explanation becomes difficult. To understand what was happening during those years, it helps to look briefly at how the federal government was funding itself before the income tax era. The primary source of revenue was the tariff system, taxes placed on imported goods coming into the country. There were also various excise taxes on specific products. This was not a perfect system. It had critics who argued it was regressive, that it raised prices on ordinary consumers, and that it protected certain industries unfairly. Those criticisms were not without merit. But whatever its flaws, the system was generating revenue, substantial revenue, more revenue, in fact, than the government consistently needed. And this is where a small but important detail enters the picture. If the surplus was real, if the federal government was genuinely collecting far more than it was spending for nearly 3 decades, then one natural consequence would have been the reduction of national debt accumulated during and after the Civil War. And that is, in fact, what the records suggest was happening. The debt that had grown dramatically during the war years was being gradually paid down during this period. The financial architecture of the country, whatever its imperfections, appeared to be functioning in a way that was producing visible results. Debt declining, surplus continuing, year after year. So then the question shifts. If the old system was generating surpluses, and if those surpluses were being used to reduce debt, then what exactly was the problem being solved by the introduction of a permanent income tax in 1913? The standard answer points to the period between the late 1890s and the early 1900s, when conditions changed, when wars created new expenses, when the surplus gave way to deficits, and when the political arguments for a more progressive tax system gained momentum. Those events are real. The timeline is real. But the gap between the 28 years of surplus and the eventual arrival of the income tax contains details that are often passed over quickly, and those details raise questions that do not resolve neatly. Something changed between 1893 and 1913. That much is clear. The surplus period ended in 1893. What followed was a decade of economic instability, financial panics, and shifting political conditions. The argument for restructuring how the government collected its revenue began gaining serious traction during these years. Some argued it was simply a matter of fairness, that the tariff system placed too heavy a burden on ordinary people, while the wealthy largely avoided contributing proportionally. Others argued it was structural, that a modern industrial economy required a more reliable and scalable source of government income. These arguments were genuine, and they reflected real tensions in American society at the time. But here's where it becomes worth slowing down. The income tax that was eventually introduced through the 16th Amendment was framed publicly as a tax on the wealthy, on the incomes of those who had benefited most from the industrial expansion of the previous decades. In its early form, it applied only to a very small percentage of the population. The rates were low. The exemptions were high. Most ordinary Americans were told they would never pay it. Whether or not that framing was accurate, and historians continue to debate how it evolved over the following decades, it was the framing that made it politically acceptable. It was the story that allowed it to pass. And this is where the timeline does not fully match the explanation. If the primary motivation was fairness, redistributing the tax burden from consumption to income, then the 28 years of surplus represent a period during which the system, however imperfect, was working well enough to keep the country financially stable without an income tax. The shift that occurred was not purely a response to financial necessity, at least not in the way the standard explanation implies. There were choices made. There were priorities set. There were decisions about what kind of financial system the country would have going forward. And those decisions did not emerge from a simple, neutral process of responding to obvious need. Some believe the introduction of the income tax was the straightforward result of progressive political pressure and a genuine desire for a fairer system. Others disagree and point to the concentration of financial power in this period, the influence of major banking interests, and the establishment of the Federal Reserve, which happened in the same year the income tax was ratified, as evidence that something more complex was underway. The precise relationship between these two events, both occurring in 1913, is one of those details that sounds minor at first, until it is examined more closely. What is difficult to explain is why these 28 years of surplus are so rarely the starting point for the conversation. When the topic of the income tax comes up in historical or political discussions, the starting point is almost always the arguments made for it, the injustices it was meant to correct, or the expansion of government that followed its introduction. The period before it, the long, uninterrupted stretch of surplus, tends to be treated as background noise, as a kind of prologue that does not require detailed examination. But if that period demonstrated that the federal government could function, reduce debt, and maintain stability without taxing income, then its absence from the dominant explanation is itself worth noting. There are records from this period: budget reports, congressional debates, Treasury documents. They are not hidden. They are publicly available and have been studied by economic historians. But the picture they present does not always align neatly with the explanation that has become most familiar. That gap between the records and the explanation is not proof of anything in particular, but it is a gap. Something was built during the years between 1866 and 1913. Something that changed not just how the government collected money, but how the entire financial structure of the country operated. The income tax was one part of that. The Federal Reserve was another. The relationship between those two structures, both created in the same year, both changing the country in ways that would only fully unfold over the following century, is not something that gets examined carefully in most standard accounts. That detail remains, for now, unresolved. What can be said is this: the version of history most commonly taught, that the income tax arrived because the old system had failed and something new was necessary, does not fully account for the evidence of those 28 years. It does not explain why a government running consistent surpluses needed a new source of revenue. It does not clearly explain what changed, or when, or why the specific solution chosen was a permanent tax on income rather than a reform of the existing system. These are not impossible questions. They are questions that deserve more careful answers than the standard explanation provides. And that is where this investigation begins. Not with a conclusion, not with a claim, but with a gap. A stretch of years that the official story moves past quickly, a surplus that lasted longer than most presidencies, a system that worked and then was replaced, and an explanation that has been repeated so many times it has started to feel like the only version that exists. Whether or not that explanation is complete, whether or not there are things it leaves out, is something the evidence, not the story, will need to answer. For now, the question stays open. There's a version of this story that most people learn at some point. It is taught in schools, repeated in textbooks, and referenced in political discussions about taxation and government finance. It is the version that has become, over time, the default explanation, and on the surface, it holds together reasonably well. That is part of what makes it worth examining more carefully. The accepted explanation goes something like this. By the late 19th century, the United States was undergoing a transformation that had few historical precedents. The country was expanding in almost every direction at once. Railroads were being built across vast stretches of land that had barely been mapped a generation earlier. Industrial factories were multiplying in cities along the East Coast and spreading further inland. Immigration was bringing hundreds of thousands of new people into the country every year, filling those factories, building those railroads, and settling into expanding urban centers. The scale of the country was changing, and according to the standard account, the financial system needed to change with it. At the center of this explanation is the argument about tariffs. For most of the 19th century, the federal government relied primarily on tariffs, taxes placed on goods imported from other countries, as its main source of revenue. The logic of the tariff system was straightforward. Goods came into the country, a percentage was collected at the border, and that money funded the government. It had worked for decades. But the argument made in the late 1800s and early 1900s was that tariffs had become an unreliable foundation for a modern government. Trade volumes fluctuated. Global markets shifted. A country that depended too heavily on international commerce for its domestic revenue was, the argument went, building its financial stability on something it could not fully control. And as the government's responsibilities grew, that unpredictability became harder to justify. This is where the income tax enters the official explanation. The solution proposed, and eventually adopted, was a direct tax on income. Unlike tariffs, which depended on the movement of goods across borders, an income tax would draw revenue directly from economic activity happening inside the country. Wages, profits, dividends, and earnings could all be measured and taxed regardless of what was happening in international trade. The income tax was presented as modern, reliable, and scalable. As the economy grew, tax revenue would grow with it automatically, without requiring constant legislative adjustment. The 16th Amendment, ratified in February of 1913, gave Congress the formal authority to levy this tax. And just months later, the Federal Reserve Act created a new central banking system designed to stabilize the money supply and manage the financial system on an ongoing basis. Both of these changes arrived in the same year. That detail tends to be presented as a coincidence of timing, a natural clustering of reforms that all pointed in the same direction. But it is worth noting, even at this stage, that the simultaneous arrival of both structures in 1913 is not something the standard explanation examines carefully. The story, as it is usually told, presents 1913 as a logical turning point. It frames the shift from tariffs to income taxation as a natural evolution, an upgrade from an older, less sophisticated system to something better suited for a modern industrial nation. The language used in many historical accounts reflects this framing. Words like modernization, reform, and progress appear regularly. The impression created is one of steady, rational improvement. The country identified a problem, debated solutions, and adopted the most sensible one available. It is a clean story, almost too clean in some ways. And this is where it becomes unclear. The official explanation focuses heavily on the problems of the tariff system, its unpredictability, its regressive effects on consumers, its inability to scale alongside a growing government. These are real criticisms. They were made at the time by people who understood the system well. But what the explanation does not engage with directly is the actual performance record of that system during the decades immediately before the push for change. Because the record, when examined, does not obviously support the idea that the system had failed. From 1866 to 1893, the federal government ran a budget surplus every single year, 28 consecutive years, without a deficit. And this was not the result of a government that was spending cautiously out of necessity. It was the result of a system that was generating more revenue than the government was spending, year after year, by a margin that was sometimes very significant. In some of those years, the surplus represented nearly 40% of total expenditures. The government was collecting far more than it needed. Debt accumulated during the Civil War was being actively paid down. The national financial position, by the measure of the budget itself, was improving steadily. That detail sounds minor at first, until it is examined more closely. If the tariff system was so unreliable, so unstable, and so ill-suited to the needs of a growing country, then what explains 28 years of uninterrupted surplus? The standard answer tends to point toward the period after 1893, when the surplus ended and financial instability increased. That is a fair observation. Conditions did change in the mid-1890s. There were economic panics, rising expenditures, and a shift in the country's financial position. But the explanation for why conditions changed after 1893, and why those changes required a permanent income tax rather than some other adjustment, is not something the official account examines with great clarity. At first, it seems like a reasonable progression, but there is a problem. The 28 years of surplus were not an accident. They were not the result of some unusual combination of circumstances that could never be replicated. They were the direct output of a system that was functioning, collecting revenue, covering expenses, and leaving a margin for debt reduction, year after year. If that system was producing surpluses so large that the government was collecting 40% more than it spent in some years, then the argument that it was too unreliable to continue requires a more specific explanation than the standard account provides. What, exactly, made it necessary to replace a system that was generating surpluses? What specifically had broken down? Some believe the answer is simply that the surpluses could not last, that the structural weaknesses in the tariff system eventually showed themselves after 1893, and that the disruptions of that period proved the reformers right. Others disagree, and suggest that the shift away from the tariff system had as much to do with who benefited from that system as with whether it was working in a technical sense. The tariff protected certain domestic industries. Removing or reducing it served certain interests. The income tax, meanwhile, was initially designed to apply to a very small and very wealthy segment of the population. The politics of who supported the change and who stood to benefit from it are not as simple as the standard explanation suggests. However, the timeline does not fully match the explanation in another important way. If the income tax was introduced primarily to create a more stable and reliable source of government revenue, then it would be reasonable to expect that stability to follow. But the history of federal taxation after 1913 is not a simple story of steady, predictable revenue. Rates changed dramatically over the following decades. The definition of taxable income shifted. The population subject to the tax expanded enormously from its original narrow scope. Whatever the initial framing, the system that emerged over time looked quite different from the modest, targeted tax on high incomes that was described to the public in 1913. Whether that evolution was inevitable or the result of specific decisions made along the way is a question the standard explanation does not really address. There's also something worth examining in how the 1913 reforms were presented to the public at the time. The income tax was widely described as a tax on the wealthy. The exemptions were set high enough that most ordinary Americans would never pay it. This was part of how it gained political support. It was framed as a correction to unfairness, a way of ensuring that those who had accumulated large fortunes through industrial expansion would contribute proportionally to the funding of the government. The Federal Reserve, introduced through the same legislative session in December of 1913, was presented as a stabilizing measure, a way to prevent the kind of financial panics that had repeatedly disrupted the economy in the preceding decades. Together, these reforms were packaged as progress, as modern solutions to modern problems. And this is where the explanation becomes difficult. The 28-year surplus is not a footnote. It is not a minor detail that can be set aside without affecting the larger argument. It is a direct challenge to the central claim of the official explanation, that the old system was inadequate and a new one was necessary. A system running 40% surpluses and paying down national debt is not, by any obvious measure, a failing system. It may have had inequities. It may have had structural limitations, that would have eventually caused problems. But the explanation for why it had to end, and why the specific replacement chosen was a permanent federal income tax combined with a central bank, is not as clear as the standard account implies. Old records from this period exist in various archives. Treasury reports, congressional testimony, newspaper editorials from the time. They paint a picture that is more complicated than the clean narrative most people encounter. The arguments made for reform were genuinely held, but the arguments made against reform and the questions raised by people at the time about what the new system would eventually become are far less often discussed in modern accounts. What the official explanation offers is a story of logical progress. What it does not fully offer is an explanation for the gap, for those 28 years, for the functioning surplus, for the debt being paid down, and for why a system producing those results needed to be fundamentally replaced rather than adjusted. That question remains, even after the explanation has been reviewed carefully. Some things were clearly changing in America in the years leading up to 1913. That much is not in dispute. But whether those changes made a permanent income tax and a new central bank the only logical response, or simply one possible response among several, is something the standard explanation leaves largely unexamined. The story it tells is coherent, but coherence is not the same as completeness, and the parts that are left out are not small ones. Every investigation reaches a point where the first real problem appears. Not a dramatic revelation, not a sudden collapse of the official story, just a number that does not fit, a detail that sits quietly in the historical record and refuses to align with the explanation built around it. This is that moment, and the number in question is not obscure or difficult to find. It has been sitting in Treasury records and congressional documents for over a century. It just rarely gets the attention it deserves. Here is the problem, stated simply. The standard explanation for why America needed an income tax rests heavily on the idea that the old revenue system was inadequate, unreliable, too unstable to support a modern, growing government. That is the framing. That is the foundation of the official account. But if that foundation is correct, then there is a specific question it needs to answer. If the old system was failing, why was the national debt shrinking? To understand why that question matters, it helps to start with a number. In 1866, the year after the Civil War ended, the United States was carrying a national debt of approximately $2.8 billion. That was an enormous sum for the era. The war had required massive spending on soldiers, weapons, supplies, and logistics on a scale the country had never experienced before. The debt that resulted was real and substantial, and the question of how to manage it was one of the central financial challenges facing the post-war government. It was not a small problem. It was not something that could be quietly ignored. And yet, within less than 3 decades, something significant had happened. By 1894, after 28 consecutive years of budget surpluses generated by the tariff-based system, the national debt had been reduced to roughly $1 billion. The math is straightforward. That represents a reduction of nearly 64% of the total debt in under 30 years. Nearly 2/3 of a war-era debt, paid down using a revenue system that the official explanation describes as unreliable and inadequate. No income tax was involved. No central bank was managing the money supply. The primary tools were tariffs on imported goods, excise taxes on specific items like whiskey and tobacco, and the consistent discipline of spending less than the government collected. That detail sounds minor at first, until it is examined more closely. A system that reduces a nation's debt by 64% over 3 decades is not, by any straightforward measurement, a system in crisis. It is a system producing results. Measurable, documented, year-over-year results. The surplus was not occasional. It was not the product of a few unusually good years, surrounded by deficits. It was consistent, 28 years in a row. And the debt reduction that resulted from those surpluses was equally consistent. The line, if drawn on a chart, moved in one direction, downward for the entire period. And this is where the official explanation becomes difficult. The argument made for the income tax relied in part on the claim that tariffs were unpredictable, that they fluctuated with international trade conditions, that they could not be depended upon to fund a government of growing complexity and expense. These are not invented criticisms. They were real arguments made by real economists and politicians at the time. But the problem is that the 28-year record does not support the idea that the tariff system was producing unreliable results. It was producing surpluses. Consistently. In some years, the surplus was so large that the government was collecting roughly 40% more than it was actually spending. That is not the profile of a fragile or unstable revenue system. That is the profile of a system generating more money than the government knew how to use. So the first doubt takes shape here. If the system was producing surpluses every year, and if those surpluses were being used to pay down a substantial national debt at a rate that reduced it by nearly 2/3 inside 30 years, then what specifically made it inadequate? What was the failure that required not just adjustment but complete structural replacement? The official explanation points toward the period after 1893, when deficits began to appear and financial conditions deteriorated. But the explanation for why conditions changed after 1893 is itself not fully examined. And even if it were, the question would remain, did those changing conditions require a permanent federal income tax? Or did they require something more targeted and temporary? This is where some historians enter the picture with alternative framings. Some point to the deflation problem. During the late 19th century, prices in the United States were falling. This was in part a consequence of rapid industrial growth, which increased the supply of goods faster than the money supply was growing. Falling prices sound beneficial in isolation, but sustained deflation creates its own set of problems. Debt becomes harder to repay in real terms. Farmers and laborers who had borrowed money found themselves paying back loans with dollars that were worth more than the dollars they had borrowed. There were genuine economic grievances tied to this dynamic, and they fueled significant political unrest during the 1880s and 1890s. The deflation argument is a real one, and it helps explain some of the instability of that period. But here is where it becomes unclear. The deflation problem and the surplus problem are not the same problem. Deflation was a monetary issue, related to the relationship between the money supply and the price level. The surplus was a fiscal issue, related to how much the government was collecting versus spending. These are connected in complex ways, but they are not identical. The deflation problem could theoretically have been addressed through monetary policy, through changes to how currency was issued and managed, without necessarily requiring a new permanent tax on income. The fact that the solution chosen addressed both issues simultaneously, through both the income tax and the Federal Reserve, both created in 1913, raises a question about whether the problems were genuinely inseparable or whether they were addressed together for reasons the standard explanation does not fully articulate. Some historians argue, interestingly, that the surplus itself was part of the problem. This is a counterintuitive claim, but has been made seriously. The argument goes that a government collecting far more than it spends creates its own distortions. Money taken out of the economy through taxes and held in government reserves rather than spent or returned reduces the amount of currency circulating in the broader economy. In a period of deflation, that withdrawal of money from circulation could have made the deflationary pressure worse. The surplus, in this reading, was not simply a sign of fiscal health, but also a contributing factor to monetary tightening. If that argument is correct, then the problem with the old system was not that it was failing to collect enough revenue. It was collecting too much, and the solution should have been to reduce taxation, not to introduce a new and permanent form of it. That argument has a certain internal logic, but it also raises its own unresolved question. If the surplus was a problem because it was withdrawing too much money from circulation, then the solution would logically have been to reduce tariff rates or return revenue to the public in some form. What it would not obviously require is the creation of a permanent income tax on top of the existing system, unless the goal was not simply to solve the deflation problem, but to restructure the entire relationship between the government and its revenue sources in a more lasting way. Some believe that is exactly what happened. Others disagree, and point to the genuine political momentum behind progressive taxation as a straightforward explanation for what occurred. The debate continues, and the evidence does not clearly settle it in either direction. There's a specific detail in the Treasury records of this period that is easy to overlook. During the height of the surplus years, there were actual congressional debates about what to do with the excess revenue. Some legislators proposed reducing tariff rates to bring collections more in line with spending. Others proposed expanding government programs to absorb the surplus. Still others argued for paying down the debt as aggressively as possible. These debates happened. They are recorded, and they reflect the reality that the surplus was large enough to be a political issue in its own right, not a sign of scarcity, but a sign of abundance. The government had more money than it needed, and elected officials were genuinely uncertain about how to handle it responsibly. That context makes the eventual solution more puzzling, not less. When a system is generating surpluses so large that legislators debate what to do with the excess, the case for introducing a permanent new revenue stream is not immediately obvious. If anything, the surplus record seems to point in the opposite direction, toward reducing the tax burden rather than expanding it. The income tax arrived not at a moment when the government was struggling to collect enough money, but after a period during which it had been collecting far too much. The gap between those two facts, the surplus era and the income tax era, is a gap that the official explanation fills with references to later deficits and changing conditions, but does not examine with the level of detail the numbers seem to require. At first, it all seems like a matter of simple historical transition. One era ended, another began. But there is a problem with accepting that framing too quickly. The 64% debt reduction achieved between 1866 and 1894 was a concrete, measurable outcome produced by a specific system operating under specific rules. It did not happen by accident. It happened because the government was consistently collecting more than it spent and applying the difference to its outstanding obligations, whatever that system's limitations, and it had real ones. That outcome represents a level of fiscal performance that is difficult to describe as failure, and yet the system that produced it was set aside, replaced, not reformed in detail, but restructured at its foundation. Old budget reports from those years still exist in various archives. The numbers are there, quietly recorded in columns of figures that most people never look at. They show the surplus accumulating year after year, the debt declining steadily, the system functioning in a way that the official explanation says it could not sustain. Why those records rarely appear in the conversations about why the income tax was necessary is itself a question worth sitting with. The first doubt, then, is not a small one. It is a direct challenge to the central premise of the accepted explanation. A system that paid down nearly two-thirds of a major national debt in under 30 years, using only tariffs and excise taxes, without an income tax, and without a central bank, does not fit the description of a system that needed urgent replacement. Something else drove the change. What that something else was, and who it served, is what remains unclear. The numbers do not offer a conspiracy. They offer a contradiction. And a contradiction, once noticed, is not easy to set aside. To understand what was actually happening during this period, it helps to slow down and look at the specific numbers involved. Not in general terms, but in concrete figures, because the numbers from this era tell a story that the standard summary tends to compress into a few broad statements. And when those statements are unpacked, the picture becomes more complicated than it first appears. Start with the basic scale of the federal government in the 1880s. The total federal budget during that decade was approximately $265 million per year. By modern standards, adjusted for inflation and the enormous growth of the economy since then, that figure is difficult to place in context. But within the terms of the era, it represented the full cost of running the United States government, its military, its administration, its infrastructure investments, its debt obligations, and every other expense it carried. $265 million. That was the machinery of the federal government, running at its full extent during one of the most economically active decades of the 19th century. And into that budget, the revenue system was delivering substantially more than required. The Treasury was collecting roughly $100 million, more per year than the government was spending. Every year, that $100 million annual surplus was not a rounding error or a temporary windfall. It was a consistent, predictable feature of the system's output during this period. The money was real. It entered the Treasury, covered all government expenses, and still left a significant remainder that was applied to the existing national debt. For a government operating on a total budget of $265 million, a surplus of $100 million represents an extraordinary margin. It is the equivalent of collecting nearly 40% more than the cost of running the entire operation. This is where a small but important question enters the picture. Where was that surplus money coming from? The answer is straightforward, and it is documented clearly in Treasury records from the period. The dominant source of federal revenue was import duties, tariffs placed on goods arriving from other countries. These tariffs alone accounted for somewhere between 50 and 60% of all federal revenue during this era. The remainder came primarily from excise taxes, most notably taxes on alcohol and tobacco. These were not complex instruments. They were not the product of a sophisticated modern tax apparatus. They were relatively simple mechanisms that had been in place in various forms for decades, and together they were generating a consistent, substantial, and in some years overwhelming flow of money into the federal government. No income tax existed. No central bank was managing the currency. No payroll deductions were taken from workers' wages. On the surface, when these facts are laid out together, the picture looks like a success story. A country growing rapidly, a government living comfortably within its means, and a revenue system producing more than enough to cover expenses and pay down debt simultaneously. Industrialization was accelerating during these same years. Millions of immigrants were arriving and moving into the expanding workforce. Cities were growing. New industries were emerging. The economic energy of the period was visible in almost every measurable indicator of national output and activity. Reading the standard accounts, it is easy to come away with the impression that everything was working. But this is where it becomes unclear. There was a structural problem embedded in the surplus itself, and understanding it requires thinking about what money actually does when it moves through an economy, and equally, what happens when it stops moving. Every dollar that the Treasury collected and held in reserve was a dollar that was no longer circulating in the broader economy. This seems obvious once stated, but its implications are significant. An economy does not simply need money to exist in total. It needs money to move. Businesses needed currency to pay workers, purchase supplies, and invest in expansion. Farmers needed access to credit to buy seed in spring, plant their crops, and survive until harvest, when they could sell and repay. Workers needed wages to purchase goods, and merchants needed those purchases to stay in business. The entire system of economic activity depended on a sufficient volume of money flowing through it continuously. When the government collected more than it spent and parked the difference in Treasury vaults, it was effectively withdrawing money from that circulation. Quietly, gradually, year after year, the surplus that looked like fiscal health from one angle was, from another angle, a slow contraction of the money available for economic activity. And during a period when the economy was growing rapidly, when more businesses, more workers, and more transactions were all competing for the available supply of currency, that contraction had consequences. The result was deflation. Deflation means falling prices, and falling prices sound, in isolation, like a benefit. Things cost less. But sustained deflation creates a particular problem for anyone who has borrowed money. When you borrow at a certain price level and repay when prices are lower, the real value of what you owe has increased. The dollars you are paying back are worth more than the dollars you borrowed. You are, in effect, repaying more than you took on, even if the number on the loan document has not changed. This was the specific experience of millions of American farmers during this period. Farming in the late 19th century operated on a seasonal credit cycle. A farmer would borrow money in spring to purchase seed, equipment, and supplies needed to plant a crop. Over the summer, the crop would grow. At harvest, the farmer would sell the crop, receive payment, and use that payment to repay the loan with interest. That cycle made sense when prices were stable. But when prices were falling year after year, the harvest sale brought in less money than anticipated, because the price of crops had fallen, while the loan repayment remained fixed at the original borrowed amount. The farmer was caught between declining income and stable or rising real debt. And this is where the explanation becomes difficult. The deflation problem was real and documented. It generated genuine political unrest. The populist movement of the late 19th century drew much of its energy from exactly this source, from farmers, laborers, and small business owners who felt the system was working against them economically, tightening credit and shrinking income while the Treasury sat on growing piles of surplus funds. The grievances were not invented. They were rooted in numbers that could be felt in daily life. The question, though, is whether those grievances pointed clearly toward an income tax and a central bank as the specific solution. Some believe they did. The argument runs that the monetary tightening caused by the surplus, combined with the deflationary pressure of rapid industrial growth, required a fundamental restructuring of both how the government collected revenue and how the money supply was managed. A central bank could manage currency more flexibly, expanding or contracting the money supply in response to economic conditions rather than letting it be determined by the fixed mechanics of gold reserves and treasury accumulation. And an income tax could replace tariffs with a revenue source that was more directly tied to actual economic activity rather than to trade volumes at the border. Others disagree and point out that the deflation problem and the surplus problem were not necessarily connected in a way that required both solutions simultaneously. The surplus could have been reduced by cutting tariff rates, which would have both returned money to circulation and addressed the complaint that tariffs raised prices for ordinary consumers. The monetary problem could have been addressed through adjustments to currency policy without necessarily creating a permanent new institution with broad powers over the money supply. The specific combination of solutions adopted in 1913 was not the only logical response to the problems identified. It was one possible response. Why it was the one chosen, and in the particular form it took, is a question the standard explanation does not fully resolve. That detail sounds minor at first, until it is examined more closely. The farmers who were struggling with deflation and credit tightness during the 1880s and 1890s were not, in the main, asking for an income tax. They were asking for cheaper credit, for relief from the gold standard's rigidity, for a currency system that allowed more money into circulation rather than less. The political platform of the populist movement, which channeled much of this discontent, focused heavily on monetary expansion, on coining silver alongside gold, and on creating a more flexible and accessible credit system for rural borrowers. The income tax was not the central demand of the people who were most directly suffering from the conditions the official explanation describes. And yet the income tax is what arrived. This raises questions that the standard account does not cleanly address. If the people experiencing the sharpest economic hardship from the system's imbalances were primarily asking for monetary relief and credit access, how did a permanent federal income tax become the legislative solution that history records? The connection between the problem as experienced at the ground level and the solution as implemented at the federal level is not as direct as the clean narrative suggests. Something else was shaping the outcome. What that something was remains a matter of genuine historical debate. There is something quietly revealing about the Treasury documents from this period when they are read alongside the political debates happening at the same time. The numbers in the Treasury reports show a government awash in surplus revenue. The congressional records show legislators debating what to do with money they had collected but did not need to spend. The newspapers and pamphlets from rural communities show farmers and workers describing economic conditions that felt like scarcity despite what the government's books recorded as abundance. These are not separate stories. They are the same story, described from different positions, and their relationship to each other is not fully explained by the account that eventually became the standard one. The surplus era, then, was not a simple success, but it was also not the failure the official explanation implies. It was something more complicated, a period of genuine fiscal strength at the federal level, coexisting with genuine economic strain at the level of ordinary people. A system that was working by one measure and not working by another. And the response to that dual reality, the specific set of solutions adopted in 1913, was shaped by forces and priorities that the numbers alone cannot fully explain. What the background details of this period reveal, when examined carefully, is that the picture was never as clean as either the critics or the defenders of the old system described it. The surplus was real. The deflation was real. The growth was real. The hardship was real. All of these things existed simultaneously, and the explanation for how all of them led specifically to the income tax and the Federal Reserve, rather than to some other combination of adjustments, is the part of the story that remains, even now, less than fully resolved. To understand what happened in the 1880s with America's political system, It helps to begin with something that both major parties actually agreed on. That agreement, when examined carefully, is one of the few moments of genuine consensus in an otherwise deeply divided political era. And yet, even within that agreement, the disagreement that followed was so sharp, so contradictory, and ultimately so damaging that it raises questions about whether the two sides were actually trying to solve the same problem at all. The point of agreement was this: the federal surplus had to go. The government was collecting far more money than it needed, year after year, and that situation was creating problems that neither party could ignore. The money piling up in Treasury vaults was not just a fiscal curiosity, it was a political liability. Voters and economists alike were noticing that the government was running like a machine set too high, pulling in resources and holding them rather than allowing them to circulate through the broader economy. Something had to change. Both Democrats and Republicans acknowledged this. That acknowledgement, however, was where the agreement ended. What came next was a disagreement so fundamental that it exposed entirely different visions of what the revenue system was actually for. The Democratic position was, on its surface, the more straightforward of the two. If the government was collecting too much money, the logical response was to collect less. Tariffs were the dominant source of federal revenue. Lower the tariffs, reduce the income, and the surplus would shrink. The reasoning followed a simple line: from problem to solution. It did not require elaborate justification or economic theory. It was the kind of answer that most people, thinking about the problem plainly, might arrive at on their own. Democrats argued this position consistently and with a degree of conviction that their opponents found threatening, because it also happened to benefit consumers. Lower tariffs meant lower prices on imported goods. Ordinary people would pay less for the things they bought. The political appeal was obvious. The Republican position was different, and this is where it becomes unclear. Republicans argued that the way to eliminate the surplus was not to lower tariffs, but to raise them. Higher tariffs, they said, would make imported goods so expensive that Americans would simply stop buying them. And if nobody was buying imported goods, then the tariffs on those goods would stop generating revenue. A tax so steep that it discourages all the behavior that generates the tax is, in theory, a tax that produces nothing. The surplus problem, by this logic, would solve itself. The government would collect less because there would be less to collect. This argument requires examination. At first, it sounds like an unusual way to approach fiscal policy. Raising a tax in order to stop collecting the tax is a method that depends entirely on people changing their behavior in response to price increases. And that change in behavior was not guaranteed. Some imports were luxuries that consumers could choose to avoid. Others were raw materials, components, or goods with no domestic alternative, meaning that even dramatically higher prices would not reduce demand significantly. The assumption that raising tariffs across the board would simply switch off the revenue stream was, at minimum, an optimistic reading of how markets actually functioned. But the argument was made, and it was made with force, by people who were intelligent and experienced in the workings of the federal government, which raises the question of whether the argument was genuinely believed, or whether it served some other purpose. In 1890, the Republican position became law. The McKinley Tariff, named after the Ohio congressman who championed it, raised average import duties to levels approaching 50%. That figure is not a small number. At 50%, the cost of a foreign-made good arriving at an American port was effectively 1.5 times its original price before any profit margin or retail markup was added. For many categories of goods, this represented a dramatic change in what American consumers would pay at the point of purchase. The McKinley Tariff also made a specific and notable decision regarding sugar. Sugar was removed from the tariff list entirely. It was, at that moment, the single largest source of tariff revenue the federal government collected. Removing it was a deliberate structural choice designed to immediately reduce income. The combination of these two moves, raising duties on most goods while eliminating duties on the largest revenue source, was presented as a coherent strategy. Higher tariffs would suppress imports and reduce income on those goods, and the sugar exemption would directly cut one of the biggest revenue streams in the system. Together, the argument went, these changes would address the surplus. What actually happened is a matter of historical record, and it does not match the theory. Prices on manufactured goods rose quickly and noticeably. Families shopping for clothing, household items, and basic manufactured products found themselves paying more. The price increases were not abstract or technical. They were visible at the level of ordinary household budgets. People noticed, and the political consequences arrived almost immediately. In the 1890 midterm elections, Republicans lost 93 House seats. It was one of the most significant midterm losses in American congressional history up to that point. The scale of the defeat was not a close call or a narrow swing. It was a collapse. Even William McKinley himself, the congressman most directly associated with the tariff that bore his name, lost his own seat. There is something worth pausing on here. A policy designed to reduce the surplus by raising import duties had instead raised prices for ordinary consumers and triggered a political punishment of historic proportions. The theory had not performed as expected. The behavior change that the policy depended on, consumers refusing to buy imported goods because prices were too high, had not materialized fully enough to prevent the price increases from landing hard on household budgets. What the policy actually did in practice was make things more expensive without achieving the fiscal adjustment it was supposed to produce. That outcome by itself might be explained as a policy miscalculation. Governments adopt economic theories that do not work as intended. That is not unusual. What becomes more difficult to explain is the specific shape of who benefited and who was harmed. The tariff increases hit manufactured goods, which were the products most likely to be purchased by working-class and middle-class households. The sugar exemption, by contrast, was a different kind of decision. Sugar was not a luxury. It was a staple. Removing it from the tariff list did reduce one major revenue stream, as intended, but it also had consequences for the domestic sugar industry and for the broader question of who would fill the resulting revenue gap. That gap did not disappear. The government's expenses had not dropped to match the new revenue reality. Something would eventually have to replace what the sugar exemption removed. And this is where the explanation becomes difficult. If the goal was genuinely to reduce the surplus by making imports less attractive, then the McKinley tariff was a failure by its own logic. The surplus was not eliminated on the timeline or in the manner the architects of the policy described. What the policy did accomplish, though it is rarely framed this way in standard accounts, was a significant restructuring of which goods were taxed and at what rates. That restructuring had winners and losers. Industries that produced goods protected by the new tariff rates were shielded from foreign competition. Industries and consumers that depended on now more expensive imports bore additional costs. The distribution of benefit and burden was not neutral. Some historians look at this pattern and argue it was exactly what the policy was designed to produce, that the argument about solving the surplus was the stated rationale, but the actual mechanism was always about who controlled the revenue system and who would benefit from its particular structure. The surplus problem provided the political justification for a major legislative intervention. What that intervention actually did was rewrite the terms of the system in ways that went well beyond simply adjusting income to match expenses. Others disagree with that reading. They argue that the failure of the McKinley tariff was simply a failure of economic prediction. The policymakers believed their theory. The theory was wrong. The consequences were real and painful, but they were the consequences of a miscalculation rather than a deliberate design. The punishment at the ballot box, by this reading, was democracy working correctly. A policy that hurt ordinary people was rejected by the people it hurt. That detail sounds minor at first, until it is examined more closely. The disagreement between these two readings, miscalculation versus deliberate restructuring, is not resolved by the historical record as it currently stands. The documents from the period show the arguments that were made publicly. They do not always show what was believed privately, or what outcomes were considered acceptable even if they were not advertised. The gap between the stated purpose of a policy and its actual effect is not always evidence of hidden intent, but it is always worth noting, particularly when the effect was foreseeable and the people making the policy were not uninformed about how tariffs and markets worked. What this chapter of the 1880s and 1890s reveals, when examined carefully, is that the political debate over the surplus was not a clean debate between two equally plausible solutions. One approach reduced the system's intake, and returned benefit to consumers. The other raised costs for consumers in the name of a theory about behavior that did not fully materialize. The consequences of the second approach were swift, measurable, and politically severe. And yet, the broader trajectory of revenue policy did not permanently embrace the first approach either. The surplus era, the tariff debates, and the McKinley episode together form a period that resists simple summary. The numbers are real. The political consequences were real. The suffering of ordinary consumers was real. But the full explanation for why the system moved the way it did, and specifically, why the restructuring of who controlled the revenue system seemed to run beneath the surface of the public debate, is a question that the standard account does not fully close. What the record leaves open is the possibility that the surplus problem was never purely a fiscal problem. It was also a question of power, of who collected money, from whom, in what form, and with what consequences for the distribution of economic advantage across the country. That question was present in the 1880s. It did not go away in the 1890s, and the specific answers adopted in the years that followed were shaped by forces that the surplus numbers alone cannot explain. To understand where the deeper mystery of this period begins to take shape, it helps to look carefully at a part of the story that standard accounts tend to move through quickly. The pension system of the late 19th century is usually described in broad terms: a benefit program for veterans, a response to the sacrifices of the Civil War, a humanitarian gesture toward the men who had fought to preserve the Union. That description is not wrong, but it is incomplete, and the parts it leaves out are precisely the parts that raise the most questions. Begin with the basic human reality of the situation in 1889. Nearly 2 million Union veterans were still alive at that point. The Civil War had ended more than 2 decades earlier, but the men who had fought in it were not old by modern standards. Most were in their 50s and 60s. Most were still working. Physical labor was the primary occupation for a large portion of this population: farming, manufacturing, construction, the kinds of work that dominated the American economy in that era. These were not men sitting quietly in retirement. They were active participants in the economic and political life of their communities. And they represented something else as well. They represented votes. A large, organized, geographically distributed block of voters who had a shared identity, shared grievances, and shared expectations of the political party that had led the country through the war they had fought. The Republican Party understood this clearly. It did not need to be told that veterans were a political asset. That understanding was embedded in the party strategy across multiple election cycles. And the organization that gave that asset its clearest political shape was the Grand Army of the Republic. The Grand Army of the Republic was the primary veterans organization of the era. By the late 1880s, it had more than 400,000 members. That number alone made it one of the most significant organized constituencies in the country. But the Grand Army was not simply a social club or a commemoration society. It functioned as a political lobby in the fullest sense of the term. It had leadership. It had chapters distributed across the country. It had a clear set of demands, and it had the organizational capacity to translate those demands into electoral pressure. Politicians who wanted veteran votes knew they had to engage with the Grand Army seriously. And the Grand Army's primary demand, year after year, was expansion of the federal pension system. At first, this seems like a straightforward political arrangement. A powerful constituency wants something. Politicians who depend on that constituency's support provide it. That exchange is as old as democratic politics. But there is a problem. The specific form that pension expansion took in 1890 raises questions that the standard explanation of the period does not fully address. The Dependent Pension Act, passed in that year, went significantly further than simply expanding benefits to veterans who had been injured in combat. The legislation granted pension eligibility to any Union veteran who had served at least 90 days and who had any disability at all. Not a war-related disability, not an injury or illness connected to their service. Any disability, any condition, any cause. A veteran who had developed a health problem years after the war, from causes entirely unrelated to their military service, qualified under the new law. The connection between service and benefit, which had been the basic organizing principle of the pension system up to that point, was effectively removed. That detail sounds minor at first, until it is examined more closely. A pension system designed to compensate veterans for war-related injuries and hardships operates on a logic that most people would find easy to accept. The government sent men to fight. Some were hurt in that fighting. Compensating them for those injuries is a reasonable expression of national obligation. But a pension system that extends eligibility to any condition, regardless of its origin or its relationship to military service, operates on a different logic entirely. It is not a system of compensation for specific harm. It is a system of income distribution to a particular group, defined by their membership in a political category, with the threshold for qualification set low enough that membership in the category is essentially the only real requirement. The results of the legislation were immediate and significant. Pension rolls nearly doubled within 4 years of the law's passage. The number of people receiving federal pension payments expanded at a pace that had not been seen before in the history of the program. The spending figures reflect this directly. Before the Dependent Pension Act, federal pension expenditure stood at approximately $89 million per year. Within a short period of the Act's passage, that figure had climbed to $159 million annually. By 1893, pension spending was consuming more than 40% of the entire federal budget. That is not a marginal line item. That is the largest single category of federal expenditure, absorbing nearly half of all the money the government was spending in a given year. And this is where the explanation becomes difficult. The federal surplus that had been the defining fiscal feature of the 1880s did not persist unchanged through this period. The pension expansion was one of the major mechanisms through which that surplus was reduced. Money that had been accumulating in treasury vaults was now flowing out in the form of pension payments to a rapidly expanding list of beneficiaries. From a purely fiscal standpoint, the surplus problem was being addressed. But the specific direction in which that money was flowing raises a question that the standard account does not linger on long enough to fully examine. The surplus was not being redirected toward infrastructure that would serve the broader population. It was not being invested in transportation systems, educational institutions, or programs designed to address the deflationary pressure that was squeezing farmers and rural workers across the country. A significant portion of it was being directed specifically toward a group defined by its political loyalty to the party in power, through a system whose eligibility requirements had just been dramatically loosened. But this is where it becomes unclear. The Pension Bureau, which administered the system, was not a small or obscure agency. It was one of the largest administrative operations in the federal government, and the people running it were aware of its limitations. The Bureau's own commissioner, at various points during this period, described the pension application process in terms that were notably candid about its vulnerabilities. The system, as the commissioner acknowledged, functioned in practice as something close to an open door to the Treasury. Applications were difficult to verify. Disability claims were often based on self-reported conditions that the Bureau had limited capacity to independently examine. The administrative infrastructure for distinguishing legitimate claims from fraudulent ones was not equal to the volume of claims the new legislation was generating. This is a significant admission. It did not come from critics of the system. It came from inside the institution responsible for managing it. That raises questions about whether the structure of the system was a product of oversight, resource limitations, or something more deliberate. Building a pension program with loose eligibility criteria and limited verification capacity is not necessarily evidence of bad faith. Government programs are routinely under-resourced and administratively imperfect. But the combination of factors here, a politically targeted beneficiary group, dramatically loosened eligibility standards, acknowledged vulnerability to fraud, and a pace of spending expansion that absorbed a substantial portion of the existing surplus, is a combination that invites examination. Some historians look at this pattern and read it as straightforward political patronage. The Republican Party controlled federal policy. Veterans were a core Republican constituency. Expanding pension spending was a way of delivering material benefit to a loyal group while simultaneously addressing the fiscal embarrassment of the surplus. The policy served multiple purposes at once, and the looseness of the eligibility criteria was not a design flaw, but a design feature. The broader the eligibility, the more voters received direct financial benefit from the party's governance. Others disagree. and argue that the pension expansion was a genuine humanitarian response to a real need. Veterans were aging. Many were experiencing health problems. The labor-intensive work that most of them did took a physical toll that accumulated over decades. The disabilities they claimed, even when unrelated to their specific service, were real conditions affecting real people who had served their country. By this reading, the loosening of eligibility criteria was an acknowledgement that the original system's narrow focus on war-related injuries was too restrictive to reflect the actual experience of aging veterans. Both readings have evidence to support them. Neither fully closes the question. What remains harder to explain is the timing and the specific fiscal context. The pension expansion of 1890 occurred at a moment when the federal surplus was at the center of a major political debate. Both parties had acknowledged that the surplus needed to be reduced. The McKinley tariff had just been passed, raising import duties while removing sugar from the tariff list in an attempt to reshape the revenue system. Pension spending was expanding simultaneously. These were not unconnected events. They were parallel responses to the same fiscal reality, happening at the same time, under the same political leadership. And this is where the question the standard account leaves open becomes most visible. If you were looking for a way to eliminate a large federal surplus quickly, directing spending toward a politically loyal group through a system with minimal verification requirements would accomplish that goal effectively. It would spend the money, it would reward supporters, and it would do so in a form that was difficult to criticize directly, because the beneficiaries were veterans, and veterans carried a particular moral status in the public imagination of that era. Questioning the expansion of veteran benefits required a degree of political courage that few legislators were prepared to demonstrate publicly. That detail sounds minor at first, until it is examined more closely. The question of intent is one that the historical record does not cleanly resolve. The documents from the period show what was passed, what was spent, and what the administrative reality of the Pension Bureau looked like from inside. They show the commissioner's candid acknowledgments of the system's vulnerabilities. They show the pace of spending growth and the portion of the federal budget that pensions came to represent. What the documents do not show, with any clarity, is the full private reasoning of the people who designed and passed the legislation. What the pension story of the 1890s leaves behind, when examined carefully, is a pattern that does not resolve into a clean explanation. The spending was real. The beneficiaries were real. The fiscal consequences were significant and rapid. But the relationship between the stated humanitarian purpose of the legislation and the political and fiscal context in which it was passed is not as straightforward as the summary version of the story implies. Something was being accomplished beyond simply helping veterans. What that something was, and how consciously it was pursued, remains a question the standard account leaves sitting quietly in the background, unresolved. There is a moment in any investigation when individual facts stop looking like separate events and start looking like something else. That moment usually arrives not when a single piece of evidence changes, but when enough pieces have accumulated that their arrangement becomes difficult to ignore. The 1880s and early 1890s in American political history represent exactly that kind of moment. Each decision made during this period had its own official explanation. Each policy had its stated purpose, its legislative justification, its public rationale. But when those decisions are placed in sequence and examined together rather than individually, a pattern begins to take shape that is harder to set aside than any single event on its own. To see the pattern clearly, it helps to lay out the sequence in plain terms. First, tariffs were raised to levels that proved immediately and politically unsustainable. The McKinley tariff of 1890 pushed average import duties to nearly 50%, a figure that translated directly into higher prices for ordinary consumers on a wide range of manufactured goods. The political backlash was swift and severe. 93 House seats changed hands in the midterm elections that followed. The congressman whose name the tariff carried lost his own seat. This was not a subtle or delayed reaction. It was an immediate verdict from voters who felt the consequences in their household budgets. A policy designed, by its own logic, to reduce federal revenue by suppressing imports had instead raised costs across the economy while generating a political disaster for its architects. Then, almost simultaneously, Pension eligibility was expanded in ways that made fraud not just possible, but, by the assessment of the Bureau's own administrators, nearly inevitable. The Dependent Pension Act removed the requirement that a veteran's disability be connected to their military service. Any condition, from any cause, at any point in a veteran's life, qualified them for federal support. The result was a rapid and dramatic expansion of the pension rolls, with spending climbing from $89 million annually to $159 million within a few years. The bureau responsible for processing these claims was overwhelmed almost immediately. Its capacity to verify the legitimacy of applications was strained beyond what its administrative infrastructure could reliably handle. And then a Congress that would later be nicknamed the Billion-Dollar Congress arrived and proceeded to dramatically increase federal spending across a range of additional categories: naval expansion, coastal fortifications, river and harbor projects distributed across congressional districts in ways that maximize political benefit. The nickname itself is telling. It was not a term of admiration. It was a description that captured the sheer scale of spending that characterized this particular legislative session, a scale that had not been seen before in American peacetime governance. The Congress earned that name deliberately, through a sequence of spending decisions that together moved an enormous volume of money out of the Treasury and into specific programs with specific beneficiaries. At first, each of these decisions seems to have its own reasonable explanation. But there is a problem. When the explanations for each decision are placed side by side, they do not form a coherent picture of a government responding to a clear set of needs. They form something else. A government that was, by various means and through various legislative instruments, rapidly eliminating a surplus that had become politically inconvenient. The methods were different. The stated justifications were different. But the fiscal outcome was consistent across all of them. Money was leaving the Treasury at a pace that had not been characteristic of the previous decade. The coastal fortifications spending is a specific example worth examining carefully. The official justification for building up America's coastal defenses during this period was national security. The country needed to protect its coastline. That argument is not inherently unreasonable. Nations do build defenses. Governments do invest in military infrastructure during peacetime. But the question of what specific threat was being defended against is one that the historical record makes difficult to answer convincingly. The only country with the naval power and the geographic position to pose a plausible military threat to American coastlines at that time was Britain. And Britain had been at peace with the United States for more than 70 years. The two countries had not been at war since 1812. Trade between them was extensive. Diplomatic relations were stable. There was no active conflict, no recent incident, no escalating tension that would have signaled an imminent threat requiring urgent coastal fortification. This raises questions that the official justification does not fully address. Building defenses against a country you have been at peace with for 7 decades, using surplus funds that multiple branches of the government had already identified as a political and economic problem, follows a particular shape. It is spending that can be described in the language of necessity and security, while serving the practical function of moving money out of reserve and into circulation through construction contracts, labor, and material procurement. Whether that dual function was the intention behind the spending or simply its effect is not something the available documents resolve with certainty. But this is where it becomes unclear in ways that extend beyond the fortifications debate. The pension fraud issue, examined in detail, follows the same general shape. It was not an accident of poor management. It was the predictable result of specific structural conditions that were built into the system and then left unaddressed as the volume of claims grew. Physicians conducting pension examinations were paid $1 per examination. That rate created an incentive structure that rewarded speed and volume rather than accuracy or thoroughness. A doctor conducting 10 examinations quickly earned the same as a doctor conducting 1 examination carefully. The rational response to that incentive for a physician trying to manage a reasonable workload was to process applications without extensive scrutiny. Approvals flowed more easily than rejections. The system paid for approvals and denials at the same rate, but only approvals generated no additional work. Pension attorneys added another layer to the same structure. Veterans navigating the claims process often worked with attorneys who specialized in pension applications. Those attorneys coached their clients on how to describe their conditions, which symptoms to report, and how to frame their claims in ways most likely to succeed. The attorneys were compensated through a portion of the pension payments their clients received. Their financial interest was entirely aligned with approval and entirely misaligned with accuracy. The more claims they processed and the more approvals they secured, the more they earned. The system rewarded the behavior that made fraud easier. And then there were the multiple widow claims. In a system where verification was limited and records were incomplete, the same dead soldier's service record could become the basis for more than one pension claim filed by different women presenting themselves as his widow. The Bureau's capacity to cross-reference claims against existing records, to identify duplicates, to verify the identity and eligibility of claimants, was not equal to the volume of applications it was receiving. The administrative machinery was simply not built to handle what the legislation had created. That detail sounds minor at first, until it is examined more closely. The Bureau's response to being overwhelmed was to find additional space for its records, and the space it found was Ford's Theater. The building where Abraham Lincoln had been assassinated in 1865, less than 3 decades before this period, was repurposed as a document storage facility for pension claims generated by the war Lincoln had led. The files of the men who had fought in his war, many of them filed under circumstances that the Bureau's own commissioner had described as an open door to fraud, were stacked in a building that had become a kind of unofficial monument to the president under whom they had served. The image is quiet and strange in equal measure. And then, in 1893, the floor of Ford's Theater collapsed. 22 clerks were killed. The building that had become a filing cabinet for the records of a system, stretched beyond its capacity, gave way under the weight it was carrying. The event was reported at the time as a structural tragedy, but it also meant that a significant volume of pension records was damaged or destroyed in the collapse. Records that might have been used to verify claims, identify duplicates, or document patterns of fraud were gone. Whether that loss was investigated thoroughly, whether anyone examined what specifically was contained in the documents that were destroyed, is not something the standard historical account spends much time on. However, the timeline does not fully match the simple explanation that this was all just administrative failure. Administrative failures are real. Governments routinely struggle to manage programs whose scale grows faster than their capacity to administer them. That is not a conspiracy. It is a common feature of large bureaucracies responding to legislative mandates. But the specific combination of conditions present in the pension system during this period, loose eligibility criteria set by legislation, a $1 examination fee that discouraged scrutiny, attorney compensation structures aligned entirely with approval, limited cross-referencing capacity, and an overwhelmed bureau storing records in a structurally compromised building, is a combination that goes beyond simple resource limitations. Each of those conditions was a known variable. Each could have been addressed by adjusting the legislative or administrative framework. None of them were addressed at the pace or scale that the situation clearly required. Some historians look at this pattern and conclude that it reflects the limits of 19th century government rather than any deliberate design. The administrative tools available to federal agencies in that era were genuinely limited. Verification at scale required record-keeping systems and communication infrastructure that did not exist in modern form. The failures of the Pension Bureau, by this reading, were the predictable result of applying pre-modern administrative capacity to a post-legislation demand surge. Others look at the same evidence and argue that the pattern is too consistent and too convenient to be explained entirely by administrative limitation. The tariff raises prices and is politically unsustainable. The pension system expands rapidly with minimal verification and a fraud-prone structure. The billion-dollar Congress spends heavily on programs whose justifications are thin. Together, these decisions drain the surplus that had been accumulating for a decade, and they do so in ways that direct the money toward specific groups, protected industries, veteran constituencies, construction contractors, rather than toward the broader population experiencing deflationary pressure and credit tightness. And this is where the explanation becomes difficult. Patterns this consistent across multiple separate policy areas, over a compressed period of time, under unified political control, do not form easily by accident. The individual explanations for each decision are available and partially persuasive. The tariff was about revenue policy. The pension expansion was about veteran welfare. The military spending was about national security. Each explanation holds some weight when examined alone, but the cumulative effect of all of them together was the rapid elimination of a surplus through channels that served politically defined beneficiaries, while the fiscal problems experienced by ordinary farmers and workers went largely unaddressed. What the pattern leaves behind, when examined from a distance, is a question about the relationship between stated purpose and actual function in the policies of this era. The standard account describes each decision on its own terms. It takes the legislative justifications at face value and measures outcomes against those justifications. But when the outcomes are examined as a group rather than individually, what they describe is something that looks less like a government solving a fiscal problem and more like a government redistributing a fiscal resource toward specific ends before the terms of the debate could change. Connecting those observations directly, with confidence and precision, is where the available evidence begins to thin. The documents show what was decided. They show what was spent. They show what the administrative reality looked like from inside the institutions involved. What they do not show, with any completeness, is the full reasoning that shaped those decisions at the level where it would matter most to the question the pattern raises. By 1893, something had changed in the basic financial condition of the federal government that is difficult to fully absorb without pausing on the numbers involved. For 28 consecutive years, the Treasury had collected more than it spent. That surplus had been a defining feature of post-Civil War American governance. It had shaped political debates, driven legislative decisions, and produced the pattern of spending choices that the preceding years had made visible. It was not a small or incidental feature of the era. It was the central fiscal reality around which everything else had been organized. And then, with a speed that the numbers make striking, it was gone. By the time 1893 arrived, less than $2.5 million remained of what had once been a $100 million annual excess. That figure requires a moment of consideration. A surplus that had been large enough to cover nearly 40% of the entire federal budget annually, year after year for nearly 3 decades, had been reduced to a remainder so small it would barely cover a single day of government operations. The transition from abundance to near depletion had happened within a compressed period of time, through the specific spending decisions that the preceding years had produced. The pension expansion, the military investments, the infrastructure projects, and the tariff restructuring had together accomplished what the standard political debates of the 1880s had described as the central fiscal challenge of the era. The surplus was gone. What arrived next is where the story becomes significantly more complicated. The Panic of 1893 did not arrive with warning signs that the government had adequately prepared for. It arrived as a cascade. Banks began failing across the country in numbers that the financial system had not seen in a generation. The failures were not isolated to one region or one type of institution. They spread through the banking network in ways that reflected how deeply interconnected the financial system had become during the preceding decades of industrial growth. As banks failed, confidence in other banks declined. Depositors attempted to withdraw funds. Institutions that might have survived under normal conditions found themselves unable to meet withdrawal demands and collapsed in turn. Gold drained from the Treasury at a pace that the government found alarming. The United States at this time operated under the gold standard, meaning that the currency supply was tied to the government's gold reserves. When confidence in the financial system declined, holders of paper currency moved to convert their notes into gold. That conversion demand pulled gold out of Treasury reserves at a rate that raised a question that would have seemed impossible just years earlier. The federal government, which had spent the better part of 3 decades accumulating surpluses and paying down debt, now found itself in a position where it was genuinely uncertain whether it could meet its own financial obligations. That detail sounds minor at first, until it is examined more closely. A government that had been embarrassed by how much money it was collecting was now uncertain whether it could pay its bills. The distance between those two conditions, measured in calendar time, was remarkably short. Within a single presidential term, The fiscal position of the United States had moved from one extreme to another. This was not a gradual decline spread across a generation. It was a rapid transition that compressed an enormous fiscal change into a period brief enough that many of the same political figures who had presided over the surplus era were still active participants in the crisis that followed. The human consequences of the panic were not abstract. Unemployment climbed into double digits and remained there. For workers who had been employed in the industries that had grown during the expansion of the preceding decades, manufacturing, construction, railroad operations, the collapse of those industries meant the loss of income that had no immediate replacement. Dozens of railroad companies went bankrupt. The railroad network had been one of the primary engines of American economic growth during the Gilded Age. Its collapse was not simply a financial event. It was a structural disruption to the physical movement of goods, people, and commerce across the country. Communities that had grown around railroad hubs found their economic foundations suddenly unstable. The depression that followed the panic was not a brief contraction. It settled over the country and lasted for the remainder of the decade. 6 consecutive years of federal deficit followed the crisis. The government that had struggled to find ways to spend its excess revenue was now borrowing to cover its basic expenses. But this is where it becomes unclear in a way that the standard account tends to smooth over. The official framing of the Panic of 1893 presents it primarily as an external event, something that happened to America rather than something that grew from within the decisions America's government had made in the years immediately preceding it. The panic is described in terms of its triggers, the silver purchases, the bank failures, the gold drain, as though those triggers arrived from outside the system rather than emerging from conditions the system itself had created. That framing is worth examining carefully, because the connection between what happened before 1893 and what happened during it is traceable in ways the standard summary does not always make explicit. The silver purchases are where the mechanical connection between the preceding era and the collapse becomes most visible. In the early 1890s, the government had been purchasing silver as part of an effort to ease the currency shortage that had been generating deflationary pressure across the economy. Farmers and rural communities had been demanding monetary expansion for years. The gold standard's rigidity had restricted the money supply in ways that kept credit tight and deflation persistent. Silver purchases were a partial response to that pressure. By bringing more metal into the monetary system, the government was attempting to expand the effective currency supply without formally abandoning the gold standard. It was a compromise between the hard money position and the inflationary demands of the agrarian movement. But the compromise created a problem that the theory had not fully accounted for. If the government was purchasing silver and issuing notes backed by silver while also maintaining the gold standard, then the relationship between the two metals became a source of uncertainty rather than stability. Investors and depositors began to question whether the government's commitment to gold was genuine. If silver notes could be redeemed for gold, and the government was issuing more silver notes, then the gold reserve was being drawn down to cover a currency expansion it had not been designed to support. That uncertainty, once it entered the financial system, was difficult to contain. Bank runs followed. Gold drained from the treasury as people converted silver-backed currency into gold at a rate the reserve could not sustain. The financial system, which depended on confidence in the government's ability to maintain its commitments, lost that confidence faster than the government could act to restore it. And this is where the explanation becomes difficult. The silver purchases were themselves a response to conditions that the surplus era had helped create. The deflationary pressure that made silver purchases politically necessary was partly a product of money being withdrawn from circulation through treasury accumulation across the preceding decades. The spending decisions of the billion-dollar Congress had moved money back into circulation, but not in the forms or at the speed that would have addressed the underlying monetary tightness most directly. The pension payments went to veterans. The military spending went to contractors. The infrastructure projects went to specific localities. None of these channels directly addressed the credit access problems of farmers or the money supply problems of rural communities in a structural way. The silver purchases were the mechanism through which that pressure was finally addressed, and they were the mechanism that destabilized the gold standard and contributed to the panic. The chain from the surplus era to the panic is not simple. but it is not absent either. Some economists who have examined this period argue that the Panic of 1893 was the predictable result of a monetary system operating under contradictory pressures. The gold standard restricted the money supply. The surplus removed additional currency from circulation. The resulting deflation created political pressure for monetary expansion. The silver purchases were the political response to that pressure, and the silver purchases undermined the gold standard's credibility, triggering the financial collapse. By this reading, the panic was not an external shock. It was the delayed consequence of choices made across the preceding decade. Others disagree and argue that the panic had causes that were not primarily domestic in origin. International financial pressures, particularly the collapse of the Baring Brothers banking firm in Britain, had created instability in global credit markets before the American crisis arrived. The outflow of foreign investment from American markets preceded the domestic bank failures and contributed to the conditions that made the panic so severe. By this reading, America was partly a victim of global financial dynamics that its domestic policy choices had not caused and could not have prevented. However, the timeline does not fully match the external shock explanation on its own. If the panic were primarily a product of international financial instability arriving from outside the American system, it would be difficult to explain why the American Treasury was so poorly positioned to absorb the shock. A government that had maintained a $100 million annual surplus for decades should have had significant reserves available to stabilize the financial system during a crisis. Instead, the Treasury in 1893 found itself nearly depleted, with less than $2.5 million remaining from what had been an extraordinary accumulation. The surplus that might have provided a buffer had been spent. The question of whether it had been spent wisely, or in ways that left the government more vulnerable rather than less, is one that the standard framing of the panic as an external event does not directly engage. That raises a question the standard account leaves open. If the decisions of the early 1890s, the pension expansion, the military spending, the tariff restructuring, the silver purchases, were each individually justified on reasonable grounds, why did their combined effect leave the government so exposed when the crisis arrived? Each decision had its stated rationale. Each had its political logic, but their aggregate result was a treasury stripped of the reserves that had been accumulating for a generation, at precisely the moment when those reserves would have been most valuable as a stabilizing resource. Whether that outcome was foreseen, whether it was considered acceptable, or whether it was genuinely unexpected by the people who made those decisions, is not something the documents resolve with clarity. The transition from surplus to crisis within a single presidential term is a fact of the historical record. The spending decisions that drove the transition are documented. The mechanisms that connected the surplus era to the panic, the silver purchases, the gold drain, the bank failures, are traceable. What is not fully resolved is the question of how those mechanisms were understood by the people who set them in motion. The official framing presents the panic as something that arrived. The record suggests it was something that developed. The distance between those two descriptions is where the question that this period leaves behind continues to sit, unanswered, in the available evidence. What the numbers from this era reveal, when examined in sequence, is that the fiscal position of the United States changed with a speed and completeness that the standard summary does not fully convey. A surplus large enough to have restructured the national debt was converted into a depression severe enough to restructure the national financial system. Both of those outcomes were real. Both left lasting marks on the institutions and policies that followed. And the relationship between them, between the choices that ended the surplus and the crisis that followed its disappearance, remains one of the less examined questions in the standard telling of how the modern American financial system came to be. Not everyone who has examined the period between 1890 and 1913 accepts the explanation that eventually became the standard one. That is worth stating plainly at the outset, because the standard explanation carries a particular kind of authority that comes simply from repetition. When an account of events is told the same way across enough textbooks, enough classrooms, and enough documentary summaries, it begins to feel less like one interpretation and more like established fact. But the period in question has attracted serious researchers who read the same documents, examined the same legislative records, and arrive at conclusions that differ from the mainstream account in ways that are difficult to dismiss without engagement. The standard explanation, stated briefly, is this: the old revenue system based on tariffs was inefficient, regressive, and inadequate for the needs of a modernizing country. The income tax replaced it with something fairer and more flexible. The Federal Reserve replaced a chaotic and unstable banking system with a managed institution capable of responding to financial crises. These were reforms. They were responses to genuine problems. They improved the system. That is the version most people encounter first, and most people encounter it without being told there is another version. But this is where it becomes unclear. Some researchers argue that describing these changes as reforms misidentifies what they actually were. The transition from tariffs to income tax, by this reading, was not primarily about fairness or efficiency. It was an architectural shift, a deliberate redesign of where the government's revenue came from and, by extension, who bore the cost of funding federal operations. Under the tariff system, revenue was generated at the border, through taxes on foreign goods entering the country. Under the income tax system, revenue was generated internally, through taxes on the earnings of domestic workers and businesses. Those two systems are not simply different methods of collecting the same money. They are fundamentally different relationships between the government and the economy it taxes. The shift in who benefited from that redesign is where the alternative argument becomes most specific. Industrial interests that depended on imported raw materials had a clear financial stake in lower tariff rates. Tariffs raised the cost of imported inputs. Lower tariffs meant lower production costs. An income tax, levied on earnings rather than on imported goods, did not directly affect the cost of raw material imports in the same way. For large industrial operations that imported significant volumes of materials, the replacement of tariffs with an income tax was not a neutral change. It was a change that reduced one category of cost while introducing a different category of obligation. Whether that trade was favorable depended on the specific situation of each industry. But for import-dependent manufacturers, the general direction of the change was advantageous. Banking interests present a parallel argument. The Federal Reserve, created by the Federal Reserve Act of 1913, established a centralized institution with significant authority over the money supply, interest rates, and the broader conditions of credit availability across the economy. Before the Federal Reserve existed, monetary policy in the United States was a more distributed and less formally managed affair. The Treasury played a direct role. The national banking system operated under constraints set by legislation rather than by a dedicated central institution with discretionary authority. The creation of the Federal Reserve concentrated monetary decision-making in a new kind of institution, one that was neither fully governmental nor fully private, but occupied a structural position between the two. Some researchers argue that this concentration of monetary authority was precisely the outcome that certain banking interests had sought for years. A central bank with authority over credit conditions and interest rates is an institution whose decisions matter enormously to financial institutions that lend money for a living. The terms on which credit is available, the rate at which money can be borrowed, the conditions under which financial panics are managed. All of these are questions that a central bank answers, and all of them directly affect the profitability and stability of private banking operations. By this reading, the Federal Reserve was not a reform that constrained banking power. It was an institutional arrangement that formalized and in some respects extended it, under a structure that was insulated from direct democratic control. That detail sounds minor at first, until it is examined more closely. The question of democratic control over monetary policy is one that the standard account treats as settled. The Federal Reserve is presented as a technical institution staffed by experts whose independence from political pressure is a feature rather than a problem. But the alternative reading points out that removing monetary decisions from direct democratic accountability is itself a political choice with political consequences. It is a choice about who gets to make the decisions that shape credit conditions, and under what constraints, and the specific form that the Federal Reserve took, its governance structure, its relationship to private banks, its degree of insulation from legislative oversight, reflected choices that were made by people with specific interests in the outcome. And then there is the timing. The 16th Amendment, which established the federal income tax as a constitutional matter, was ratified in 1913. The Federal Reserve Act, which created the central bank, was passed in 1913. The 17th Amendment, which changed the method of electing United States senators from selection by state legislatures to direct popular election, was also ratified in 1913. Three significant changes to the structure of American governance, each presented as a separate and independent reform responding to its own specific set of problems, all arrived in the same calendar year. At first, this seems like a coincidence of reform energy. But there is a problem. The standard account presents these three changes as unrelated. They emerged from different reform movements, different legislative processes, and different sets of political actors with different motivations. The income tax was a progressive era response to inequality. The Federal Reserve was a response to financial instability. The direct election of senators was a response to concerns about corruption in state legislatures. Each had its own history, its own advocates, its own justification. The fact that all three arrived in 1913 is, by the standard account, simply a reflection of a particularly active period of reform rather than evidence of coordination. Some researchers find that explanation insufficient. They argue that three structural changes of this magnitude, each moving power in a consistent direction, arriving simultaneously, require a more complete explanation than the coincidence of reform energy provides. The income tax gave the federal government a revenue mechanism that reached directly into the earnings of every working person in the country, regardless of trade conditions or border activity. The Federal Reserve removed monetary authority from the Treasury and placed it in a new institution with a different governance structure. The direct election of senators altered the political incentives of those legislators, shifting their accountability away from state governments and toward the broader electorate and the campaign financing structures that shaped access to it. Each of these changes, examined individually, can be described in terms of its stated reform purpose. But this is where the explanation becomes difficult. When the three changes are examined together, the consistent direction of their structural effects becomes visible in a way that individual examination tends to obscure. Each change moved decision-making authority away from one set of actors and toward another. The income tax moved revenue collection away from the border and toward the interior. The Federal Reserve moved monetary authority away from the Treasury and toward a new centralized institution. The direct election of senators moved political accountability away from state legislatures and toward a different set of influences. Whether the consistent direction of these shifts was the product of coordinated planning or the coincidental result of independent reform processes arriving at the same moment is a question that the historical record does not answer with certainty. Some believe the coordination was real. They point to the overlapping networks of individuals involved in the legislative and advocacy processes that produced all three changes. They note that the same period saw significant activity by banking interests, industrial lobbying groups, and reform organizations that had relationships with key legislative figures. They argue that the appearance of three independent reform movements producing three structurally consistent changes in a single year is more likely to reflect coordination than coincidence. By this reading, 1913 was not simply an active year for reform. It was the year in which a long-developing restructuring of American governance was completed. Others disagree, and the disagreement is genuine. The reform movements that produced these changes had deep roots that predated the specific political conditions of 1913. The income tax had been debated for decades. The instability of the banking system had been generating calls for a central bank since at least the Panic of 1893. The corruption of state legislature appointments of senators had been a documented problem for years. The simultaneous arrival of solutions to these separate problems, by this reading, reflects the maturation of multiple long-running reform processes rather than a single coordinated plan. The people involved in one reform were not necessarily the same people involved in the others. The legislative histories are distinct. The advocacy organizations were different. The argument for coordination, by this reading, imposes a pattern on events that were genuinely independent. However, the timeline does not fully resolve the question either way. What is harder to dismiss than either the coordination theory or the coincidence theory is the structural result that both sides of the debate acknowledge as real. Regardless of whether the three changes of 1913 were coordinated or independent, their combined effect was a government with a new revenue mechanism, a new monetary institution, and a Senate whose members faced a different set of political incentives than their predecessors. That result is documented. It is not a matter of interpretation. The question of whether that result was intended, planned, and pursued deliberately, or whether it emerged from the convergence of independent processes, remains genuinely open. And this is where the absence of consensus becomes part of the story itself. Historical debates that remain unresolved after more than a century of examination are not common. Most questions about events this well documented eventually reach a point where one interpretation accounts for the available evidence more completely than the others, and the debate settles into a rough consensus. The question of what 1913 represented, reform or restructuring, coincidence or coordination, improvement or capture, has not settled in that way. Serious historians continue to disagree about it. The documents are extensive. The legislative records are available. The participants left behind correspondence, memoirs, and public statements. And yet the fundamental question of what was driving the changes, and whose interests they ultimately served, remains contested. Some researchers point to that persistence of disagreement as evidence that the question is genuinely complex. Others point to it as evidence that the standard account has been more thoroughly defended than examined. The difference between those two readings is itself a matter of perspective that the available evidence does not resolve. What the alternative views of this period leave behind, when examined carefully, is not a clear counter-narrative that replaces the standard one. They leave behind a set of observations about structural outcomes, consistent directions of change, and overlapping timing that the standard account does not fully address. The mainstream explanation describes what was said publicly about these changes. The alternative views ask what the changes actually did, and for whom, and whether the answer to those questions matches the stated purpose closely enough to close the question. For some researchers, it does. For others, it does not. And that disagreement, sitting quietly in the historical record, is something the standard summary tends to move past more quickly than the evidence perhaps warrants. There is a number that does not appear in most standard history textbooks. It is not hidden exactly. The records exist. The figures are a matter of public documentation, but the number is rarely presented in a way that invites examination. For 28 consecutive years, the United States government ran a budget surplus. Not occasionally, not most years. Every single year, for nearly 3 decades, the government collected more money than it spent, and it did this without an income tax and without a central bank. That is worth pausing on for a moment. The two institutions that most Americans today treat as simply part of how government works, the federal income tax and the Federal Reserve, did not exist during those 28 years. The government funded itself through a different mechanism entirely. Tariffs, primarily. Taxes collected at the border on goods entering the country. It was not a perfect system. It had critics, and some of those criticisms were valid. But by at least one straightforward measure, the ability to collect more than you spend, it worked. Year after year, for an uninterrupted stretch that no administration since has come close to matching. And the debt did not just stop growing during this period. It shrank. The United States paid down nearly 2/3 of its national debt in less than 30 years. That is not a small achievement. That is a sustained and documented reduction in the financial obligations of an entire country, accomplished without the mechanisms that modern fiscal policy considers essential. The numbers are not in dispute. What remains in dispute is what those numbers mean, and why the period that produced them receives so little detailed attention in the standard telling of American financial history. This raises a question that is difficult to answer cleanly. If a country ran surpluses for 28 consecutive years and paid down most of its debt, the natural expectation would be that this period would be studied carefully, that policymakers and historians would return to it repeatedly, asking what conditions made it possible and whether any of those conditions could be recreated. But that is not what happened. The surplus era is not a celebrated chapter in American economic history. It is mentioned briefly, if at all, and usually in the context of explaining why the old system was inadequate and why the new one was necessary. The years of surplus are framed as a prelude to modernization rather than as an achievement worth examining on its own terms. And this is where it becomes unclear. The standard explanation for why the old system was replaced describes it as unstable, inefficient, and poorly suited to the needs of a growing industrial economy. Those are reasonable-sounding criticisms, but they sit uneasily next to the actual record of those 28 years. Instability, in a financial sense, usually produces deficits, debt accumulation, and periodic shortfalls. The surplus era produced the opposite. The system that is described as unstable was, during the period under examination, generating consistent surpluses and enabling significant debt reduction. Whether that record is compatible with the instability argument is a question the standard explanation does not always address directly. Some researchers argue that the description of the old system as unstable is accurate but incomplete. They point to periodic banking panics, disruptions in credit markets, and the genuine difficulties that an economy without a central bank faced during financial crises. Those problems were real. The Panic of 1893 and the Panic of 1907 both caused significant economic disruption. The absence of a lender of last resort created genuine vulnerabilities. By this reading, the fiscal surplus existed alongside structural weaknesses that the surplus numbers alone do not capture. The system was producing revenue efficiently while simultaneously leaving the financial system exposed to shocks it could not manage well. Others find this explanation partially satisfying, but incomplete in a different way. They point out that banking panics also occurred after the Federal Reserve was created. The Great Depression, the most severe financial collapse in American history, happened 17 years after the Federal Reserve was established. If the purpose of the new system was to prevent the kind of instability that the old system had allowed, the early record of that new system raises questions of its own. The institution created to manage financial crises did not prevent the largest financial crisis the country had ever experienced. That detail is not always included in the account of why the old system needed to be replaced. But this is where the timeline becomes more difficult to set aside. Within 4 years of the changes made in 1913, the surplus was gone. That is not a gradual transition. That is not a slow adjustment as a new system found its footing. The 28-year record of consistent surpluses ended abruptly, and it did not return. In the more than 130 years since the surplus era ended, the United States has never come close to matching that record. There have been occasional years of surplus, brief stretches in the 1990s, when revenue temporarily exceeded spending, but nothing resembling the sustained, uninterrupted surplus that existed before the system was replaced. What the old system produced consistently, the new system has not reproduced in more than a century of operation. That observation does not, by itself, prove anything. Systems change. Circumstances change. The United States fought 2 world wars, built a massive military establishment, created large social spending programs, and expanded the scope of federal activity far beyond what existed in the surplus era. Comparing fiscal outcomes across periods that different in so many ways is genuinely difficult. The surplus era existed in a country with a smaller government, a smaller population, and a different set of international commitments. Whether the surplus would have survived even without the changes of 1913 is a question that cannot be answered with certainty. However, the question of why 3 major structural changes arrived simultaneously is harder to set aside with that explanation. The 16th Amendment established the federal income tax. The Federal Reserve Act created the central bank. The 17th Amendment changed how senators were elected, shifting accountability away from state legislatures and toward a different set of influences. All 3 arrived in 1913. The standard account presents them as separate responses to separate problems, each with its own history and its own reform coalition. But they did not arrive separately. They arrived together, and each of them moved authority in a consistent direction, away from one set of actors and toward another, away from distributed decision-making and toward more centralized structures. Some believe the coordination behind that simultaneous arrival was real. They point to overlapping networks of individuals who were involved in the advocacy and legislative processes that produced all 3 changes. They note that banking interests, industrial lobbying groups, and certain reform organizations maintained relationships with key legislative figures during this period. The argument is not that a single individual or a single organization directed all three changes from a central location. The argument is that the interests which benefited from the structural outcomes of 1913 were not passive observers of a reform process that happened to serve them. They were participants, and their participation shaped what the reforms looked like and what they ultimately did. Others disagree, and the disagreement is not easily resolved. The reform movements that produced the changes of 1913 had histories that stretched back decades. The income tax had been debated since at least the Civil War. Calls for banking reform had intensified after every major financial panic. The direct election of senators had been advocated for years before it finally passed. By this reading, 1913 was simply the year when multiple long-running reform efforts finally accumulated enough political support to succeed. The simultaneous arrival of these changes reflects the particular political conditions of that moment, not coordination among interests pursuing a shared agenda. The legislative records are distinct. The advocacy organizations were different. Imposing a single coordinated explanation on what were genuinely separate processes, by this reading, misreads how historical change actually works. And yet, the structural result of those changes is not itself in dispute. Whatever drove the changes, the United States that emerged from 1913 had a government with a new revenue mechanism that reached directly into the earnings of working people, a new monetary institution with authority over credit conditions and the money supply, and a Senate whose members faced a different set of political incentives than they had before. That is the documented outcome. Whether it was designed to produce that outcome, or whether it arrived at that outcome through the convergence of independent processes, is the question that remains genuinely open. What makes that question difficult to close is not a shortage of evidence. The documentary record for this period is extensive. The participants left behind correspondence, legislative testimony, memoirs, and public statements. The records of the debates in Congress are available. The communications of the banking interests that lobbied for the Federal Reserve have been examined. The advocacy materials of the reform movements have been studied. The evidence is not missing, but different researchers examining the same evidence arrive at different conclusions about what it means. And that persistence of disagreement, more than a century after the events in question, is itself something worth noticing. Historical questions this well documented usually reach resolution, not always perfectly, not always with complete consensus, but usually with a rough settling of the debate in one direction. The most plausible explanation accounts for the available evidence more completely than the alternatives, and the question recedes from active dispute. The events of 1913 and the surplus era that preceded them have not followed that pattern. Serious researchers continue to disagree about what was driving the changes, what interests they ultimately served, and whether the description of the old system as inadequate is compatible with the actual record of what the old system produced. Some point to that persistence of disagreement as evidence of genuine complexity. The period was complicated. The motivations of the people involved were mixed. The outcomes were not cleanly separable from the conditions that produced them. By this reading, the failure to reach consensus reflects the actual difficulty of the historical question rather than any failure of examination. Others point to it as evidence of something different. The standard account of this period, they argue, has been more thoroughly defended than examined. The description of the changes of 1913 as straightforward reforms responding to genuine problems is repeated across textbooks, classrooms, and documentary summaries in a way that gradually acquires the authority of established fact. But repetition is not the same as verification. An account that is told consistently enough begins to feel settled even when the underlying questions remain open, and when a version of history that is told consistently enough is examined carefully against the actual record. The 28 years of surpluses, the debt reduction, the abrupt end of both, the simultaneous arrival of three structural changes, and the more than century-long failure to reproduce what the old system produced. Some of the gaps in that version become visible in ways that the standard summary tends to move past. What is left, when the examination is done carefully, is not a clean alternative explanation that replaces the standard one. It is a set of documented observations that sit uneasily alongside the official account. A surplus that lasted 28 years and then ended permanently. A a system described as unstable that produced results the replacement system has never matched. Three structural changes that arrived simultaneously and moved authority in a consistent direction, and a historical debate that has not settled in the direction most well-documented debates eventually settle. The financial architecture most Americans live inside today, the income tax, the Federal Reserve, the perpetual deficit, was built within the living memory of people who knew something different, people who had seen a system that, for nearly 3 decades, did what fiscal systems are supposed to do. Whether what replaced it was an improvement, a necessity, or something else entirely, is a question the available evidence leaves open. And open questions, as it turns out, are exactly where the most important history tends to hide. And so the question does not close neatly. It stays open in the way that certain historical questions tend to stay open, not because the evidence is missing, but because the evidence points in more than one direction, and the people examining it cannot agree on which direction matters more. That is an uncomfortable place to leave an investigation. Most people prefer resolution, a clear answer, a final verdict, but the record of this particular period does not offer one, and forcing a conclusion onto evidence that does not support it cleanly would itself be a kind of distortion. What can be examined instead is what happened after. The years following 1913 did not unfold quietly. The new revenue mechanism, the income tax, began modestly. The initial rates were low. The number of people who actually paid was small. For most working Americans in 1913, the income tax was something that existed on paper more than it existed in their daily lives. But the structure was in place. The constitutional authority had been established. And a structure with that kind of authority does not stay modest for long, because the conditions that keep it modest can change, while the authority itself remains. That is worth noting carefully. Within a few years of the income tax being established, the United States entered the First World War. Wars are expensive. They require revenue on a scale that peacetime budgets do not. The income tax, which had been introduced at low rates affecting few people, became the mechanism through which that wartime revenue was raised. Rates increased. The number of people subject to the tax expanded. What had entered the system as a modest instrument became, under the pressure of wartime necessity, something considerably larger. And when the war ended, the rates came down somewhat, but the structure did not return to what it had been before the war began. The expansion that wartime necessity had justified did not fully reverse when the necessity passed. This is a pattern that appears more than once in the history of this period. Institutions created for one purpose, under one set of conditions, tend to operate differently when conditions change. The Federal Reserve was created in 1913. It was presented as a mechanism for managing financial instability and preventing the kind of banking panics that had disrupted the economy in previous decades. But the Federal Reserve that existed in 1913 was not the same institution that existed 10 years later or 20 years later. Its authorities, its relationships with the government, and its role in the broader economy evolved over time. Whether that evolution represented the institution fulfilling its intended purpose or expanding beyond it is a question that different researchers answer differently. And this is where the long-term picture becomes harder to ignore. The deficit that replaced the surplus after 1913 did not correct itself. It did not behave like a temporary disruption caused by unusual circumstances. It became, with only occasional interruptions, a permanent feature of American fiscal life. The government spent more than it collected, year after year, and the debt that the surplus era had reduced began to grow again, slowly at first, then more quickly, then at a pace that the surplus era, even at its most productive, would not have been able to reverse. The trajectory that began in the years after 1913 has continued, with variations in speed but not in direction, ever since. Some argue this was inevitable. A modernizing country with expanding responsibilities cannot be expected to operate on the same fiscal model as a smaller, simpler government. Social programs, military commitments, infrastructure investment, and the general expansion of federal activity all cost money. The surplus era existed before most of those commitments existed. Comparing the fiscal outcomes of a small government to those of a large one is, by this reading, not a meaningful comparison. The deficit is not evidence that the system changed for the worse. It is evidence that the country changed, and the system changed with it. Others find that explanation too convenient. The argument that deficits are simply the cost of modern government assumes that the spending which produces them is itself necessary and well managed. But the question of whether the spending is necessary is separate from the question of whether the institutional structure makes it easier to spend without constraint. A government that funds itself through tariffs is limited, in a practical sense, by the revenue those tariffs generate. A government that funds itself through an income tax and has access to a central banking system that can manage the money supply has a different relationship with fiscal constraint. Whether that difference in constraint is a feature or a problem depends on how one evaluates the outcomes it has produced. But the outcomes are documented. The national debt has grown in nearly every decade since the surplus era ended. The brief exceptions, periods where debt as a share of the economy declined, did not reverse the long-term direction. The trajectory is not ambiguous, and the institutions that were put in place in 1913, whatever their intended purpose, have operated throughout that entire period. They were present during the expansion of debt in the 1920s. They were present during the Depression. They were present through the post-war period, through the stagflation of the 1970s, through the deficits of the 1980s, and through every subsequent decade. The institutions did not cause all of those outcomes directly, but they were the structural environment within which all of those outcomes occurred. That detail is not a conclusion. It is an observation. The people who designed the changes of 1913 are not available to explain what they intended. Some left behind records that suggest they believed genuinely in the reforms they were creating. Others left behind records that suggest their motivations were more specific to the interests they represented. The historical record does not produce a single clean portrait of intent. What it produces is a set of structural outcomes that can be examined against the stated purposes of the institutions that produced them, and a set of questions about whether those outcomes match those purposes closely enough to close the debate. For more than a century, the debate has not closed, and there is something in that persistence worth sitting with for a moment. The income tax, the Federal Reserve, the permanent deficit, these are not ancient or immovable features of the American system. They were designed. They were debated. They were passed by specific people at a specific moment in history, for reasons that those people explained publicly and may or may not have fully disclosed privately. The 28 years that preceded them were also designed, in a sense, built on a different set of choices about how governments should fund themselves and what roles centralized financial institutions should play. Both systems were human constructions. Both reflected the interests and beliefs of the people who built them. The difference is that one of them is still in operation, and the other exists only in the historical record. And the one that exists only in the historical record produced a surplus for 28 consecutive years and paid down most of a national debt, while the one still in operation has not reproduced that outcome in more than a century of trying. Whether that comparison settles anything is a question each person examining the evidence must answer for themselves. The record does not answer it. The institutions do not answer it. The historians who have spent careers studying this period have not answered it in a way that has produced consensus. What remains is the evidence, the structural outcomes, the timeline, and the questions that have not been fully resolved by any of the explanations so far offered. That is where this investigation leaves things. Not with a verdict, not with a final answer, but with a set of documented facts that do not fit together as cleanly as the standard account suggests, and a set of questions that have been asked for more than a century without receiving answers that have satisfied everyone who has examined them. The most important history, it turns out, rarely announces itself. It sits quietly in the record, waiting for someone to ask why the numbers do not match the explanation, and to keep asking even when no clean answer comes.